Hello everyone! Today I'll be talking about the inventory costing method FIFO. Let's break it down first. Inventory refers to a tangible resource that is held for resale in the normal course of operations. This can include fruit, cars, or even computers. Determining the cost of this inventory can be done with one of these four methods: specific identification, FIFO, LIFO, and moving average. LIFO stands for last in, first out, and is actually illegal in Australia. The reason for that can be explained using the example of eggs. Say a supermarket buys 3 eggs. According to LIFO, the most recent egg bought must be sold first. Using a product that has an expiration date easily shows why a country like Australia would see that this form of inventory costing method would be illegal. Now let's move back to FIFO. FIFO means first in, first out. This means inventory is assumed to be sold in the order it is purchased, which is following the physical flow of most companies. For example, if a company bought 3 tables, the first table that was bought would be the first one sold, and the third one would be the third one sold. Pretty simple. Let's try to go through the technicalities. Here are the calculations using the FIFO method for the company Handbags Galore. Suppose on the 1st of November, their beginning inventory is 30 handbags, which were bought for $15 each, totaling $450. Their first purchase of inventory for the month is 70 handbags at $17 each. This new inventory is added to the previous inventory on hand, totaling 100 handbags in inventory, costing $1,640. When it comes to selling the inventory on hand, the FIFO method comes in. If Handbags Galore sells 50 handbags, the 30 bags at $15 are all sold first, as they were bought first and must go out first. The other 20 is taken from the 70 at $17. After this transaction, the 50 left are all from the first purchase of the month, totaling $850. The second and third purchase simply works the same as the first one, and again, when 60 handbags are sold on the 30th of November, the 50 is taken from the first purchase of the month and 10 from the second, resulting in 70 handbags on hand at $1,285 at the end of November. With the assumption that inventory prices keep rising, the ending inventory cost using the FIFO method will be the highest out of the 4, but have the lowest cost of goods sold. The final step is to determine the cost of the inventory, which can be shown with this table. The cost of goods available for sale, which is also the inventory cost, is determined by adding all inventory on hand for the month, which was the original 30 and the 70, 55, and 25 bought during the month. All the costs added together equals $3,175. The ending inventory of 70 at $1,285 is deducted from the cost of goods available for sale, and ta-da! There are 110 handbags sold, which cost $1,890.